Welcome to the first edition of Trilogy Talks, the official podcast of Trilogy Funds. My name is Wyatt Leonard, Head of Distribution. Today, we're pleased to host Tim Lawless, Executive Research Director at CoreLogic. Recognized as the leading authority on residential property, Tim publishes highly sought-after commentary on real estate market conditions and the interplay between housing markets, demographic trends, and economic factors. Joining Tim is Trilogy Funds Executive Director and Head of Lending and Property Assets, Clinton Arentz. When Clint joined Trilogy back in 2017, he brought with him decades of experience in property development, project delivery, and asset management across residential, commercial, and industrial projects. During his time at Trilogy, Clint has been instrumental to the growth and management of both our private credit fund, the Trilogy Monthly Income Trust, and our industrial property trust. Between them, they have almost 60 years of property experience. And on today's episode, they'll be discussing the key themes they're seeing in the Australian property market and the headwinds and tailwinds facing the sector in 2024. Whether you're an investor, an advisor, a broker, or perhaps looking to get into the property market for the first time, we're sure there's something for you in today's episode.
So, Tim, great to catch up again. Always good to have a chat and get your thoughts on what's happening in the market. You know, property in Australia is a $10 trillion sector, as we know, and Trilogy Funds is one of the larger non-bank lenders in the construction space. So we, of course, watch the RBA's announcements with some interest. And I see they've kept a relatively neutral stance this time, leaving the rate at 4.35%. But, they've set some cautionary guidelines there around falling retail sales and perhaps slightly weakening labour conditions and a slight softening in the economy, but still appears remarkably robust, and asset prices are holding up well across the country. So interested to get your thoughts on that too.
Yeah, absolutely, Clint. Thanks for inviting me in as well. So a $10.3 trillion asset class. To put that into context, it was only a year ago, so January 2023, the housing asset class was about $9.3 trillion. So it's gone up by about $1 trillion in the space of a year, mostly because of value growth. Pretty strong year, but also we've seen more housing being built, of course, not enough. But the RBA decision, I think, was widely expected. But what wasn't expected was the ongoing, the tightening bias that the RBA kept. There was a lot of speculation leading into the RBA meeting that they might become a little bit more dovish. They might start to indicate that, we're at the peak of the rate hiking cycle and the next move might be downwards. Michelle Bullock was pretty clear to hose that down. And in fact, she was explicit that there could be another rate hike. It depends on the flow of the data. And I think that's probably the most important thing here is the flow of the data has been pretty compelling. My view is we are at the top of the rate hiking cycle and the next move will be down. Probably the biggest inflection point here has been inflation, coming down to 4.1% at the end of last year. That well and truly beat the RBA forecast, which was at about 4.5%, and they've since revised their forecasts lower for inflation now. It's a good chance we'll probably see inflation below 4% coming into sort of the mid to high threes by the middle of this year. Again, really good news. And that's, of course, going to be weighing on the RBA's decision to, hopefully bring rates down later this year. But as you say, there's other factors as well. There's really a really weak household sector. Consumers aren't spending all that much. We're seeing housing prices have slowed down. They're still rising, but not rising as quickly. I think that's probably a little bit of reassurance to the RBA that there isn't going to be a flow-on to the wealth effect, which they've been quite cautious about. And what I mean by that is, the more we see housing values rising, the higher the potential is that households will spend more because they feel wealthier if you're a homeowner. So leading into the RBA meeting, we're generally seeing financial markets expecting a rate cut, probably around about July. Since the RBA meeting, that's been pushed out a little bit now to about September or October. So still, it does look like we'll probably see a rate cut later this year. Most economists are thinking either September, November, December for the first rate cut, and then more rate cuts coming into 2025.
So I guess ultimately supply and demand always plays an important factor, doesn't it?
Absolutely.
And people's aspirations and attitudes have seemingly changed during COVID, and it seems to us now that they're largely baked in. I mean, the work from home concept is very hard to dislodge now, and some companies still report high predominance of people working from home. We've seen regional shifts, a lot more decentralisation coming out of the mainstream cities into stronger regional growth areas right up and down the east coast of Australia effectively. add to that the migrant push, as you mentioned, is a lot of people are on the move. And so that creates some demand patterns in places that haven't experienced those sorts of levels of demand probably ever before, and consistent demand, Gold Coast being a good example.
Absolutely. Some of those regional anomalies in internal migration rates seem to have settled down a little bit now, but they've certainly settled at above pre-COVID levels. So think about the internal migration movements we saw during the worst of the pandemic. People were leaving the capitals to move to regional markets, and there were fewer people leaving regional markets to go to the capital cities. And of course, that created a lot of demand for regional housing. Remember, regional housing across Australia had generally underperformed compared to the capital cities, mostly because there wasn't that demand driver. So we ran into this really interesting situation where there was very strong demand, no supply response whatsoever. Everybody wanted to live with some space. Space became a real premium, and that really drove up regional housing values, a lot more than capital city values. That trend changed through 2023. We actually saw capital cities rising faster than regional markets, playing a bit of catch up. But coming into the end of last year and early this year, that's once again starting to change a little bit. Capital cities are slowing in their price growth. Regional markets are holding relatively firm at a fairly sustainable growth rate now, I'd probably describe it as. So once again, we're seeing regional markets quite strong. And a lot of those really high-profile regional markets, think about your classic Byron Bays or your Noosa's or the Southern Highlands. A lot of those markets saw housing values rise by more than 60% through the pandemic. Then they moved through a pretty steep downturn. Byron, for example, fell in value by about 25%, well and truly on the up again. So I think a lot of people that missed the boat through that pandemic upswing have really been positioning themselves in the market now, taking advantage of the fact that values have fallen substantially below their peaks.
Absolutely, and very hard for those builder groups and developer groups to navigate through, because we saw ourselves, they all experienced supply chain disruption, and they're all managing different levels of demand patterns, and so their timelines all shift around accordingly. But they were remarkably resilient. Our client group of developers worked their way through the whole COVID period remarkably successfully. Projects were completed in the normal course and ultimately sold and the capital repaid. And I think one reason for that was the smaller scale of the projects that we tend to lend on. So projects upwards of 50, 60 million in value and perhaps 30 odd million dollars in debt. But our typical loan size is more like 10 to 15 million. And so they're small, discrete projects that can be mobilised quickly. And there's an army of those projects all over the country being rolled out at any given time. And they're the unsung heroes of the supply solution, because they're always coming through. But of course, they don't get the headlines of the large high-rise towers and the like, which seem to be particularly impeded at the moment with construction cost increases, supply issues, and viability issues as well.
Yeah, absolutely. That missing middle, as a lot of people describe it as, the sort of medium density in already established suburbs, is so important, especially when you think about a lot of areas that have existing transport spines going through them or established working nodes. That's exactly where we need to be building more housing supply, but also non-residential supply is very much in tune with those markets as well. So great to see those sort of initiatives happening. I agree that the developers in that space tend to be a lot more nimble. They tend to be much more innovative, getting around barriers to introducing supply. But when you get to the really big bulky projects, your high-rise and so forth, that's where we've seen a real slowdown in construction activity.
And of course, construction delivery plays a part as well. I mean, the larger the project, the more they're competing with tier one builders, and those builders have obviously got more infrastructure work than they've had for decades, I would argue. And Brisbane particularly has an Olympics effect as well. And so for the larger scale builders associated with those, mainstream large projects, towers and high rises and the like, I mean, they're particularly adversely affected. The smaller builders who can basically just get on with the job and be on site on a daily basis seem to be the ones that are following through. But land subdivision's another factor, because we've been able to roll out land subdivisions all through central Queensland, central New South Wales, in and around the Central Coast as well, over time and over the last few years. And literally, Tim, those land sales have flown out the door when the land's been completed. So you can tell there's absolutely a long-term trend to regions that either have those employment drivers or lifestyle choice. So that's going to take some of the pressure out of the cities a little bit. But But equally, the cities create most of the jobs. So, we still need more and more product here in all of the capital cities.
Yeah, I think there's a lot of those areas that tend to be in the sweet spot where they're outside of the capital city. They might be outside the metro boundary, yet they're still commutable. They might have a lifestyle dividend associated with them, maybe slightly larger land blocks, or they're close to the coastline or in a hinterland location. Some really good examples of that would be the Gold Coast, the Sunshine Coast of Toowoomba here in southeast Queensland. Go to outside of Sydney. Classic Central Coast became hugely popular through the pandemic and has held prices really well. But even going further afield to your Newcastles, Lake Macquarie's, down to Wollongong and Illawarra, sure. Melbourne to Geelong would be the same case. So, and out to Bawbaw. So we're seeing that all around the country. And again, I think part of this is just the legacy of the pandemic where people can work remotely, at least part of their working week. And if they need to be back in the office, which might be in the CBD, then it's still a commutable drive, although you probably wouldn't be wanting to drive every day if you're commuting in from, say, Byron or something like that.
And it's highly likely that with the migrant intake, and particularly if there's skilled migrants, that we'll see a boost to construction delivery over the next few years, with a lot of those people being able to be diverted into the construction sector, I imagine.
Yeah, well, let's hope that's where the skilled migration is really focused, and the industry is, of course, where we need it. And I think absolutely residential and non-residential construction trades is desperately needed in Australia. Once we start getting more trades coming through, then you'd have to think, that government's stretch target, if you will, of 1.2 million well-located dwellings over the next 5 years might become a little bit more attainable. But at the moment, considering dwelling approvals are still extraordinarily low and below average, it's looking pretty hard to attain anything close to that 1.2 million target over the next 5 years.
Definitely. And I was just thinking that the central banks, and particularly the Reserve Bank, have done a remarkably good job in a way of orchestrating the notional soft landing. And it would appear that that's how it's playing out. I mean, demand is still strong and interest rates look like they might ease. I guess that's what they aspired for in the first instance. And that's been reasonably well orchestrated in most of the Western economies to some extent. But even in Australia, there's disparity between the states. And of course, I mentioned earlier the Olympics effect in Brisbane, where we're seeing a lot of infrastructure being rolled out, a lot of demand for those larger builders and larger sub-trades as well. Sydney, I guess, has always had a prevalence of large-scale projects, and it's always had a bigger infrastructure spend than New South Wales, at least, has had a bigger infrastructure spend than the rest of the country, and Melbourne probably less so. I'd be interested in your thoughts on the relative disparities between those three cities and how you see the tale of three cities emerging over the next 2 to 3 years.
Yeah, isn't it fascinating? So we've still got Sydney well on top in terms of housing prices, a significant premium. Melbourne is building up this burgeoning affordability advantage over Sydney. In fact, Melbourne is now more affordable than Brisbane, just at a raw value in terms of a median value, but when you adjust for incomes, it's even more affordable than Brisbane now. Outside of that basket of three, you've also got markets like Perth and Adelaide to a lesser extent that are absolutely booming also. So I think that the medium to longer term outlook probably does favour southeast Queensland. At the moment, it just looks like it has much stronger fundamentals of, it's got a very positive rate of interstate migration that's fueling housing demand. It's also got the very strong rate of overseas migration that will flow through with a bit of a lag. It's got a lot of big infrastructure projects, a strong economy, relative affordable advantage compared to Sydney at least. Sydney, clearly an unaffordable market. We've now seen the gap between house values and unit values in Sydney has risen to record highs, like a 70%, nearly 70% difference between the two housing types. You'd have to think that's going to start deflecting more demand towards the medium to high density sector, not really out of any probably desire or demand from Australians to want to live in an apartment or medium density, but that's where their budget's going to be taking them, I think, when you have such a significant premium for houses. Melbourne is probably starting to look a little bit better to me, even though it's underperformed through the pandemic and through to now. As I mentioned, it's got a really strong affordability advantage now over Sydney. It does have more developable land. It's not as land constrained as what a market like Sydney is, so you can go sort of further out without getting running into the water. And I think also, hopefully we start to see some different styles of taxation policies being introduced in Victoria. That's probably one of the things in the background that's really taken away some of the demand in that marketplace, is that there's been a raft of new taxes and new policies which have clearly been aimed at trying to dig the government or the state out of was quite a deep debt hole.
Yes, and anecdotally and factually, we can see that play out through our loan book exposure in Melbourne, where there's a hesitation there now that doesn't exist in Sydney and Brisbane. But I'm sure that'll recover, given the magnificence of Melbourne as a city on a global scale. So that's probably more of a time issue, just resolving that. But it was interesting to note, and quite anomalous really, that dwelling approvals for apartments particularly are lower. They're down, 20-odd% down in December, I think I read. So at the same time as we're needing more and more apartments rolled out everywhere, as we've been discussing, we're seeing a lower rate of approval. So I wonder what your thoughts are on that.
Yeah, and that's happening everywhere. We're not seeing a supply response across any sector of the marketplace, but much more visibly in that medium to high density sector. So recall prior to the pandemic, there was a real surge in medium to high rise construction activity. That peaked in about 2017 or 18. And ever since then, we've been seeing medium to high density approvals have generally been tracking at below the decade average. No real supply response. There was the home builder program that very much favoured detached housing, and that saw a big surge, a significant surge in construction activity for houses. Definitely not apartments, at least anywhere near the same extent. I think we're getting to the stage now where there's going to be a lot more focus on this medium to high density sector. We need to see more densification around our transport spines in areas where there's a captured working population. It makes a lot of sense for governments to really leverage the investment they've made in transport to put a larger population around train lines, busways, major arterial roads, and so forth. I think the big impediment at the moment is simply the fact that delivering a project, a medium to high density project, is quite expensive. So attracting that premium from a retail sense is quite hard. So feasibilities aren't really stacking up at the moment, and the lending environment, at least in the the banking sector, is still quite cautious in that sector as well.
And I think I read in one of your papers recently, that you see the construction cost cycle as normalising. So we too share that view that construction costs obviously took a steep increase during COVID with all those supply constraints we mentioned, not the least of which workers and trades were locked down in their individual local government areas and often impeded across state borders. And so just the sheer delivery work was very, very difficult. But that's sort of coming through at a much better rate now in that sense. And construction costs, we see the increase is reducing and arguably stabilising. And selling prices and values are still strengthening. So it won't be too long before you get the right balance between cost and value again for most of those projects. But the real sharper end of town have got projects working now. So the good news is there is supply coming through. We've got that healthy pipeline I mentioned earlier. And we'll continue to lend in those core markets of ours in Queensland and New South Wales and Victoria, because these are genuine projects that have real viability in the current market with no future speculation required. They're understood in today's cost terms and today's value terms, and there's a rate of sales there that you can extrapolate and at least take a view that, look, this project looks like it's on solid ground. And with only first registered mortgages, which is the only activity we run through our mortgage trust, is first registered mortgages. We're the senior lender in the transaction, typically geared at 60 or 65%. So there's a lot of confidence in the system that that's a robust model. And even during COVID, we were able to maintain quite low default rates, which was a very fortunate aspect. But something that we'd attribute our 25 years of good management to get to this point, the enormous amount of resource and back-of-house skill sets through the Trilogy Funds operation to help guide those developers through the ebbs and flows and the little pitfalls that they'll hit along the way, particularly if they're smaller builders or developers, where if they're delivering smaller projects, they won't have the same resources to study macroeconomics or global trends, whereas we get to see a national snapshot of how projects are rolling out. And hopefully have added some value to the supply chain in that regard and to our developer clients, and secured good returns for our investors as well through the process.
Yeah, I think one of the best outcomes from construction costs stabilising they're not going backwards, of course. They're now rising at a much more normal pace, below average, which is great. The best thing that coming out of that, of course, is that developers and builders get some confidence back. They can quote confidently. They know that they can put a feasibility together and probably have a pretty good chance it's not going to blow out like what we saw over the past couple of years. I mean, just the past 3 years, we've seen construction costs rise by nearly 25%. If you're on a fixed price contract and you get confronted with something like that, then it's clear why there have been so many liquidity pressures.
Absolutely. Yeah, and I think that's why there's been a predominance of builder failure in the home builder sector as well, because they were on those staged payment contracts and there were big gaps between the stage payments, obviously. So for a smaller builder, even for the larger ones that had probably too many contracts on the go, they suffered. Our contract type, our approach to construction delivery and that of our borrowers is completely different. So the monthly progress draws that were measured by a quantity surveyor and checked by the consultants that we needed to have involved in that particular project, whether it be a project manager, superintendents and the like, all of which came as part of the project structure, but that we would monitor from our lending perspective. Those things kept those smaller projects on the rails, and there was a degree of flexibility between the builder who'd been engaged to construct and the developer who'd engaged that builder. There was some flexibility in how the contract could be assessed. There were some provisions around contingency, some provisions around escalation, both for time and for cost. And there was reasonableness on the part of the developers to maybe adjust some of their final finishes and the like. So as you were saying right at the outset, they were more dexterous and they managed to, the smaller developer groups managed to navigate their way through those challenges by swapping materials or swapping sub-trades and just using some entrepreneurship to bring their projects home in good order. So Tim, overall, I mean, how would you capture your thoughts on the year that was for 2023 in our property space that we've been discussing?
Yeah, it's hard to have a single word for 2023. It was strong, absolutely. It was diverse, and it was probably a year of two halves in many ways. So if you think about the first half of last year, it was generally characterised by Sydney, once again, really leading the cycle of growth, especially Sydney's top end of the market, the more expensive properties, leading the cycle. Most markets followed pretty close, but it was quite clear about the middle of the year, after the May and the June rate hikes, Sydney and Melbourne both started to lose momentum. Hobart was already a really weak market, so was Canberra. Listing numbers started to become more active as vendors became more active in the marketplace. But other markets, Brisbane's probably the best example, Perth, Adelaide as well, really accelerated into the second half of last year. These cities are more affordable. They continued to see vendor activity quite low. So listing numbers finished the year in all three of those markets about 40% below normal, whereas Sydney and Melbourne had normalised. They saw listings getting back to above average levels, which is one of the reasons why we saw the heat coming out of the market. So very different, very diverse from city to city. But I think overall, if you think about where the forecasts were for 2023, the end of 2022, it was generally for relatively weak conditions given what was happening with interest rates and the fact that we're seeing pretty rapid slide in housing values up until about January of 23, and then everything just turned around.
And any particular headwinds that you're sort of seeing on the horizon that might come forward that could be further impediments to a recovery?
Absolutely. There are definitely still headwinds in this marketplace, even though we're still seeing housing values rising and there's still demand in the marketplace. One of the biggest headwinds, I think, is simply just the fragility of the household sector. We know that households are still quite heavily indebted. When you look at that at a macro view, you've got a house price to income ratio, a house debt to income ratio. It's up at about 170% or so. So the last time we saw debt levels this high, interest rates were a lot lower than what they are now. So that's probably going to be one of the challenges is cost of living has been quite high, savings buffers have been eroded, and we've got relatively high debt levels. So for the same reason, it means that lower interest rates against a fairly sensitive household sector will probably have a bigger impact than what they might in the past. Other headwinds, of course, you can look at this as both a positive and a negative, would be supply. So I say a headwind because we need more housing supply coming into the marketplace, but we know there's a lot of barriers for getting more supply into the market. The good news, I suppose, from a housing perspective, if you're a homeowner, is that probably does place some upwards pressure on housing prices. The other one is, of course, interest rates are going to be coming down later this year, would be my view. But I think that is going to be a fairly gradual process, and they're coming down from well above average levels. So the cash rate at 4.35%, we'd need to see it fall about a little bit more than 7 times on 25 basis point falls to get back to the pre-COVID decade average, which is about 2.6%. So even though rates are likely to come down, it's going to be a fairly gradual process, I'd say. And we shouldn't expect rates will very quickly get back to average levels.
No, but sufficient, I guess, to mitigate ongoing inflation increases and to potentially foster a reasonable level of demand, housing demand moving forward. And I guess if there's a tailwind there somewhere, it's probably that, rising consumer sentiment, perhaps off the back of slightly falling rates, more certainty, I suspect, around job holding and job progression. So people can feel a bit more confident post-COVID that they've got a clear career path ahead of them in that sense and might be more inclined to invest. And we could see more investors coming into the market, I guess, too, given some of the stats of late last year where the investors were back on the rise again after a bit of a pause for quite a while during COVID. And, of course, the strong migration factors as well might also be headwinds or tailwinds, I should say, that keep driving that sector forward.
Yeah, I agree, Clint. I think the tailwinds are enough to outweigh the headwinds and see housing values rise through the year. It may be a year of two halves. The first half of this year, relatively soft until interest rates start to come down. But I agree. Now that we've got cost of living pressures clearly reducing, coming back to more normal levels, it'll be a while before they get back to target range, but they're on their way. Lower cost of living, ultimately lower interest rates, both of those things, even the expectation that rates will fall together with lower cost of living pressures should be enough to boost sentiment. And we know that sentiment and housing markets are highly correlated. So a rising consumer spirits should also be accompanied by more housing activity. And, other factors, of course, rates coming down should be stimulatory as well, not just for consumers and for home buyers, but also for getting more supply into the marketplace for builders and lenders hopefully becoming a little bit less cautious as well.
So with your national sort of overview of how you see the markets, do you think there are opportunities for people to access those markets now, people starting out as first home buyers, people looking to make their first investments, people looking to trade up or perhaps even downsize? How do you see that they can all get traction in the market moving forward?
Well, it's fair to say, Clint, that affordability is still a real challenge, right? We've seen housing affordability on every measure worsen through 2023, mostly because values have risen more than incomes and interest rates are very high. That affects affordability from a serviceability perspective, and rental affordability is also worsened because rents have risen so much. So even with affordability pressures as severe as what they are, on top of cost of living pressures being quite high, we've still seen first home buyer growth quite strong in 2023. And I think there's a few reasons for that. One would be simply the tightness of the rental market, pushing more renters out of a rental situation into a buying situation if they have the financial ability to do so. I think a lot of renters are just fed up with how tight rental markets are and how much rents have risen. So if you can save up a deposit, or if you can take advantage of some of the opportunities from the federal government, or you might have a benefactor, Bank of Mum and Dad seems to be talked about a lot at the moment as well, then there are obviously ways to get into the market. But outside of all that, clearly we are seeing more first home buyers looking at different types of options, a unit rather than a house, regional rather than capital city, or out of fringe rather than middle ring suburbs. All of those examples offer up an affordability advantage. But of course, there are going to be probably a growing portion of first home buyers who want to be first home buyers that are still finding it really hard to get into the marketplace.
I think what also runs with that is something we've certainly observed through our own developer client base and the projects they roll out is they're much more innovative now in terms of design solutions. Every square metre counts. So there's somewhat of a minimalist approach in some projects just to take any waste out of the system, if you like, and deliver up a quicker, better, more cost-effective project, but also the regionality of locating in different areas and rolling out where the land is available. And so I suspect with investors and buyers generally having more mobility now and greater access to national data and being able to travel again post-COVID, and being willing to shift completely, their place of domicile to where the jobs are and where the properties are available for their owner-occupiers. If they've got that mobility and a willingness to move and a willingness to sort of take on board new cultures, new locations and move around the country a little bit, there should be a great facilitation of solving some of those accommodation issues quicker than if people all stay immobile in their one spot and want to all sort of do that in their capital city locations.
Yeah, absolutely. Even smarter housing design, which you touched on just there, Clint. The design of homes is much better now than it used to be. Mixed use spaces within a dwelling, utilising public green space rather than having a big backyard is also something that's becoming much more common now as well. And as we talked about earlier on, I think one of the legacies of the pandemic is going to be this normalization in remote working. Maybe not as entrenched as it was through the height of the pandemic. A lot of companies are trying to get their staff back in the office a few days a week at least, if you're in the right sort of industry. But it does look like that's going to have some permanency to it as well. Most companies, if they do have the sort of workforce that can work remotely, 2 or 3 days a week seems to be quite normal.
So the patterns continue to change, I guess, and that's the way property's been for hundreds of years or longer. I mean, there's always evolution, there's always progress, and I guess through this whole period, through COVID and all of the vicissitudes that have come with that, developers and constructors and the whole industry has become more innovative, more dexterous, and hopefully that'll see the sector through for the next decade or more.
Well, they say change is the only thing that you can really count on, right? So, and no doubt that's going to be the way forward is innovation and change and adaptability, depending on what the environment's doing, is always going to be a feature of the market.
Well, Tim, it was great to catch up and have a proper chat and learn a little bit more from your perspective and hopefully throw some light on some of these key elements that are affecting our industry at the moment. Really appreciate your time and always great to catch up.
Thanks, Clint. Absolute pleasure. And I'll see you on the next one.
Thank you for joining us. If you like the content, please share and subscribe. Thank you.